Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about THERMON GROUP HOLDINGS INC. Quarterly Report. THERMON GROUP HOLDINGS INC. offers a wide range of engineered industrial process heating solutions to various industries across the globe. The company's product portfolio includes heat tracing solutions, such as software automated engineering design services, heat tracing products, smart connected control and monitoring systems, construction services, and maintenance services. In addition to heat tracing solutions, THERMON provides tubing bundle solutions, temporary power systems, heated blankets, electric heat tracing cables, steam heating solutions, controls, monitoring, and software, instrumentation, project services, industrial heating and filtration solutions, and other complementary products. The company also offers environmental heating solutions under various brand names, including Roughneck, Norseman, and Katadyn. Furthermore, THERMON provides process heating solutions under the Caloritech brand name, filtration solutions under 3L Filters, rail and transit solutions under Hellfire, Velocity, ArcticSense, and other brands. The company also offers electric resistance, electrode and fired coil tube boilers under Vapor Power, Precision Boilers, and Caloritech brands. In terms of services, THERMON provides project services such as engineering and design, procurement and project management, turnkey construction installation, recurring facility assessment or audit, and maintenance services. The company operates an electron cross-linking facility and serves various markets including general industrial, chemical and petrochemical, oil, gas, power generation, commercial, food and beverage, rail and transit, and others. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to skyrocket. The stock price of THERMON GROUP HOLDINGS INC. has seen a significant surge in the past year, leaving investors and analysts eager to understand the underlying reasons behind this trend. Several factors could be contributing to this upward momentum. One possible explanation is the company's strong financial performance, including revenue growth and increased profitability. This can lead to higher investor confidence, driving up demand for the stock and subsequently pushing its price upwards. Another factor that may have contributed to the stock's rise is the company's strategic business decisions, such as expansion into new markets or acquisition of complementary businesses. These moves can enhance THERMON GROUP Holdings' competitive position, increase its market share, and ultimately boost its stock price. Additionally, changes in industry trends or regulatory environments could also be influencing the stock's performance. Furthermore, external factors such as economic growth, interest rates, and investor sentiment can also impact a company's stock price. A strong economy with low interest rates can create a favorable environment for stocks to rise, while a shift in investor sentiment towards riskier assets can drive up demand for THERMON GROUP Holdings shares. In conclusion, the surge in THERMON GROUP HOLDINGS INC.'s stock price over the past year is likely due to a combination of factors, including strong financial performance, strategic business decisions, and external market conditions. THERMON GROUP HOLDINGS INC. market capitalization of $2 billion is materially smaller than most of its industry peers of roughly $8 billion. THERMON GROUP HOLDINGS INC. trades at a lower price-to-earnings ratio of 28 times and a lower price-to-book ratio of 3.07 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The company maintains a moderate leverage profile, with liabilities making up 34% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of various market trends and customer behaviors. On one hand, several key factors have contributed to revenue growth. Firstly, increased project activity has led to higher sales, while rising demand tied to electrification and decarbonization initiatives in Europe has also boosted revenues. Additionally, the successful implementation of pricing initiatives and steady demand from long-standing customers have further contributed to revenue growth. Furthermore, certain regions have experienced significant revenue growth. The US LAM segment saw a 9.6% increase, while Canada reported a 1.4% growth. EMEA and APAC also recorded notable gains, with 36.5% and 8.8% increases respectively. On the other hand, revenue decline has been observed in APAC, partly due to lower product sales. However, this decline was offset by greater project activity in the region. Overall, these findings highlight the importance of understanding regional market trends and customer behaviors in driving revenue growth or decline. Net income and profit margins have undergone significant changes in the given period. Initially, net income decreased by $248 from $18,539 in Q3 2024 to Q3 2025. However, on a year-to-date basis, net income increased by $5,282 from $36,544 in YTD 2024 to YTD 2025. Profit margins have also shown improvement. The gross profit margin increased by 0.4% to 46.6% in Q3 2025 and by 1.1% to 45.9% on a year-to-date basis. Although the operating profit margin is not explicitly stated, it can be inferred that it has remained stable or increased due to the expansion of gross margins. The reasons behind these changes are attributed to higher sales volumes, favorable pricing actions, efficient operational execution, and comparatively higher margins on projects. Additionally, lower interest rates and average outstanding principal balance have contributed to the improvement in profit margins. A closer look at profit margins by segment reveals varying levels of profitability across different regions. The US LAM segment reported a margin of 23.4%, while Canada had the highest margin at 33.6%. In contrast, EMEA and APAC segments recorded lower margins of 8.7% and 20.3%, respectively. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the latest figures, the net cash provided by operating activities for the 9 months ended December 31, 2025, stands at a substantial $36,149 million. This significant amount of operating cash flow indicates that the company is successfully managing its day-to-day operations and generating sufficient funds from these activities. The figure of $36,149 million is a clear indication that the company's business model is yielding positive results, allowing it to maintain a healthy financial position. The company's debt level has undergone significant fluctuations over the past year. Initially, there was a decrease in long-term debt from $120,366 to $115,823, page 4. However, this trend reversed with an increase to $125,000 by December 31, 2025, page 9. The debt level continued to rise, reaching $122,854 by the end of 2025, page 17. Nevertheless, a significant decrease was reported in page 29, where the debt level dropped from $160 million to $141 million. In contrast to the varying debt levels, interest expenses have generally decreased or remained stable. A notable exception is the brief increase in interest expense, net by $3,609, page 22. However, this spike was followed by a decrease of $374,000, minus 15%, from 2024 to 2025, page 28. Furthermore, page 29 reported a substantial drop in interest expenses, decreasing by $19 million. Overall, the company's debt level has experienced significant changes, while interest expenses have remained relatively stable or decreased. The performance of various segments and regions within the company has been inconsistent. On a positive note, the US LAM and Canada segments have consistently reported high segment profits, indicating strong growth and profitability in these areas. In contrast, the EMEA region has struggled with low segment profits, suggesting underlying issues that need to be addressed. Furthermore, the APAC region has experienced declining revenue, which is a concerning trend that requires immediate attention from management. Overall, while some regions have shown promise, others are lagging behind, highlighting the need for targeted strategies and investments to drive growth and improvement in underperforming areas. Management is optimistic about the company's outlook, citing several key strategies to drive growth and success. The primary goal is to strengthen its market position worldwide through strategic acquisitions, such as the FATI acquisition, which will enable the company to expand its reach and increase revenues. To achieve this objective, management plans to manage foreign currency risk and implement cost-cutting measures to maintain a consolidated leverage ratio and fixed charge coverage ratio. Additionally, they aim to recognize remaining revenues within the next 12 months and pursue emerging growth opportunities through strategic acquisitions. The company will also focus on delivering its backlog, responding to new market developments, and increasing revenues. Furthermore, management plans to integrate acquired companies and achieve synergies from these acquisitions, while making required debt repayments. In terms of capital allocation, management intends to execute a disciplined strategy that supports growth through performance-based compensation-related costs. The company will also continue to progress in its diversification strategy, driven by increased demand across various end markets. Overall, the company's outlook is positive, with a focus on strategic acquisitions, cost management, and revenue growth. Management is committed to delivering results and achieving long-term success. The company's financial activities have been documented in its recent reports. One notable aspect is the company's decision to buy back shares, which indicates a strategy to increase shareholder value by reducing the number of outstanding shares on the market. This move suggests that the company is confident in its future prospects and believes that buying back shares will benefit its investors. On the other hand, the company has not paid dividends to its shareholders. This decision may be due to various reasons, such as prioritizing investments in growth initiatives or maintaining a strong cash reserve for potential future needs. Despite this, the company's focus on share buybacks demonstrates its commitment to rewarding its shareholders through alternative means. There are concerns about inventory buildup and supply chain disruption in the company's operations. The data shows that raw materials inventory has increased by $20,235, while finished goods inventory has risen by $5,785. This suggests a potential issue with managing working capital requirements effectively. However, it is not just inventory buildup that poses a problem. Supply chain disruptions are also a concern. Material disruptions at manufacturing facilities could lead to shortages and increased costs. The company has already incurred tariff costs of $0.5 million for 3 months and $2.1 million for 9 months. Furthermore, increased lead times, expedited shipping costs, temporary raw material shortages, and potential impacts of tariffs or supply chain challenges are also looming. The combination of inventory buildup and supply chain disruption could have significant consequences for the company's operations and bottom line. It is essential to address these issues promptly to mitigate any potential risks and ensure business continuity. That concludes the financial summary for THERMON Group Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.